And hello and welcome to Rig's webinar with Mr. Ken here, our 1031 expert, not just 1031, but all things tax related. We had him speak at our Rig's monthly meeting, I believe it was September, and he had a very good presentation. That presentation was recorded. It's on our website. So you can go realtyinvestorsgroup.org and you'll be able to see that. The PowerPoint's there, so you can kind of look through the slides. But anyway, it was a lot of good discussion. A lot of questions was raised and answered. And then, even then, we said, we want to expand on this a little bit because he just hinted just a little bit about upcoming possible presidential changes and tax plans. Tonight, Ken's going to go in a little bit in depth on that. And he's going to do a lot of different areas, but I'll let him talk about it. But Ken, take it away, introduce yourself, and you've got the floor.
All right, great. Thanks, Jim. Go ahead and share my screen just to make sure that's working properly. So if it is, everybody should see a Colorado flag graphic. All right, sounds good. Good to know we're up and running here. So the idea tonight is to talk about taxes and their impact on our livelihoods, I think for the most part, or at least a serious interest of all of ours, which is real estate investing. My name's Ken Palmen. That CES there by my name stands for Certified Exchange Specialist. Just means I've gone through some training and an exam to get that designation from a group of qualified intermediaries that have banded together around the country. We are part of what's known as the Federation of Exchange Accommodators. That's our national association. My firm, Exchange Resource Group, is based here in the Denver area, actually headquartered in Lakewood. I have a second office up northwest part of the city over in the Louisville Business Park, but barring COVID, I'm typically all over Metro Denver and up and down the Front Range. My cell phone, email there, you're welcome to reach out anytime should you have a question on 1031 exchange. In particular, if it's tax related, I'll tell you what I can with the disclaimer that as an intermediary, I'm not allowed to give tax or legal advice since that's not technically our area of expertise or role when we're working with a client or advisors. All right, so let's dive into this thing. So we're going to cover a couple of different topics that all relate to taxes and real estate. We'll start off with a brief review of what a 1031 exchange is, what it can do for any of us as U.S. taxpayers, and how it works. And then we'll get into the meat of things, which is the Biden proposed tax plan as we know it, highlights how it compares and contrasts with current tax law, and then potential impacts that it could have on real estate investing, the industry, anyone working in this realm. And finally, a little bit of a wrap up, call to action, what we might want to be keeping in mind and how we may want to react depending on how things go. Okay, so first part of this, little recap on section 1031. Not sure if everyone on board here has participated in a 1031 exchange or would say that they know quite a bit about it. This will be a pretty quick high-level view, not getting into the details. If you ever need that information again, please reach out. 1031 has now been around 99 years and some number of months. It will officially reach the century mark next year, God willing. Since that time, it has served as a way for taxpayers to transform taxable sales into non-taxable events or exchanges of properties. These deferrals can be transformed into forgiveness, tax forgiveness, with appropriate planning. most likely estate planning. And I probably will touch on that a little bit as we go. 1031 has encouraged more transactions over its 100-year life, and therefore been a driver of the economy. So we think it's very beneficial to anyone willing and open to the idea of taking advantage of this part of the tax code. We like to say that we love this term, wealth building velocity. It can maximize that rate at which someone who is utilizing it can build their wealth. Or if they're a company or an entity, it's not so much about building wealth as it is about the bottom line, right? About profitability. And it can also help to maximize profitability. So it's very powerful, and we'll give some examples and more explanation on that. So what is it? Well, it is a section of tax code, section 1031, and it says that, and this is a quote from the code, I think just about a quote, there might be a word here or there that we didn't put in just for space saving sake. But essentially, if a taxpayer sells or exchanges property that has been held for productive use in a trade or business or for investment, and receives something like kind, meaning it is also property that will be held for productive use, then it qualifies for Section 1031 tax deferral treatment. One of the great things about Section 1031 is that it's very broad. So essentially, any property on US soil other than a primary residence can qualify. Any form of real estate. And if it's other than simple fee interest ownership, then it must be a 30-year or longer leasehold interest. So even a lease can qualify if it gets to a term of 30 years, including renewal options. So with that in mind, you can throw out different types of real estate. You've got residential, you've got commercial, industrial, you've got mineral rights, you've got water rights, air rights, easements, long-term leases. Those are all like kind to one another as long as they are held for business or investment use. Even something like a vacation home can possibly qualify. There is gray area, and then it gets into, is there income derived from the property or not? Is it used extensively by the owner as a second home, a vacation home or not? So essentially, just about any property other than a primary residence can qualify for Section 1031 deferral treatment. And really the only other requirement is that if the property on one side of the exchange is domestic, lower 48, Hawaii, Alaska, Northern Mariana Islands, Guam, and the US Virgin Islands, then the property on the other side must also be within one of those areas, okay? Someone can do an exchange of foreign for foreign property as well. You just can't go domestic to foreign or vice versa. How does the 1031 work? Well, when someone sells in the more common straight exchange, meaning they're going to sell first and buy later, to the extent that they reinvest their net sale price, meaning their gross sale price less customary closing costs, and they reinvest that into new real property, they can defer any and all gains that would otherwise be taxable from that sale. We, as a qualified intermediary, help our clients to follow the letter of the code. We help them in consulting to know what they may want to do, what their options are, and we provide the safest way possible to hold proceeds during the exchange, because the taxpayer or the exchanger cannot have actual or constructive receipt of the cash from their sale. Rather, we hold that, and then they tell us when they're ready to close on replacement property where that money needs to go to close on their new property. When it comes to taxes, that I would say is the other very powerful component. So one, you've got a lot of flexibility. Two, some people are under the impression still that 1031 helps me with my capital gains. That's true, it does, but it does more than that. It actually allows for the deferral of all taxes. So the highest tax rate, without getting into normal income rates, if someone were to hold a property for a short amount of time, doesn't qualify for capital gains, or if they're an entity and they have to pay at their corporate income rate, barring those situations, the highest tax rate is depreciation recapture, which is at a 25% rate. So anytime you've got a property that has a structure on it, it's being depreciated, or the tax code says it should be depreciated. And when you sell that, the IRS wants a 25% recapture of that benefit given on the depreciation. Capital gains, for most taxpayers that would be dealing in real estate transactions, it's going to be a 15 or a 20% rate. Currently, a joint filer goes to that higher 20% when they exceed about 480,000 of adjusted gross income. That does include gains from the sale of real estate. So it's a pretty big number, much higher than an average income in our country. However, if you've got two working people that file joint and they sell some real estate that they've had for a while, it's not uncommon that they could hit that higher threshold for capital gains. Next, you've got state income tax. There are some states, a handful, that have no state income tax, all the way on up to California, the highest in the country. Probably not a shocker to anybody. They have a tiered structure, fairly complicated, also probably not a shocker. But if someone sells property in California for over $1 million, I believe it is, their tax rate is 13.2% just to the state of California, on top of all the federal taxes. So Colorado is at 4.63, by the way. I believe we voted down the measure to reduce our state tax rate to 4.55. I can't say that with 100% certainty, but it's a pretty minor adjustment either way. So we're at about 4.6% to the state of Colorado. Then finally, if a taxpayer is doing an interstate transaction, I'm going to sell in Colorado and buy in any other state, Colorado wants a transfer tax paid. But with the 1031 exchange, you can fill out a form. That tax can also be deferred as it can in other states. And then finally, got what's known as the Medicare or Obamacare surcharge. Technically, it's this NIIT. That's a 3.8% hit. So you add all of those up, and you can have a blended tax rate pretty easily in the low 20s, if not higher than that. And with the 1031 exchange, that can all be deferred. The only exception are our friends in Pennsylvania that for some reason decided, you know what, we don't want to recognize 1031 when it comes to our state income tax. So they are the one state where they will still collect their roughly 9% when someone sells property in their state. Okay, now we're going to get into highlights of the proposed Biden administration tax plan. So the first being income tax rates going up. The current rate is 21%. I think President-elect Biden, in one of his debates, even touched on this particular topic, saying, yeah, our current maximum rate is 21%, but the average corporation is paying something like 14%. It seems a little ironic to me that then the proposal is, well, we're going to just take it to 28% instead of, well, maybe we need to look at why that is and fix it so that if we intend corporations to pay 21%, how are they getting around it? Anyways, that's the little bit I know about how tax rates work in this country, right? It does seem that the larger corporations are able to find ways around the maximum rates, even though they're some of the wealthiest corporations in the US and in the world. So regardless, we've got a proposed 25% increase in the corporate rate. And for individuals, repeal of Trump's tax plan that took effect for the most part on January 1, 2018. TCJA was the Tax Cuts and Jobs Act, and it set the current maximum rate for individual income tax at 37%. And the Biden team has said, well, we're going to repeal that, and that maximum rate would go back up to where it was under Obama. So not a major change there. What's maybe more significant is some of the middle income brackets. Those are taking somewhat of a higher hit in the proposed plan. And then the lower income earners are receiving a break, or their rates are staying the same. Okay, second highlight would be the elimination of capital gains treatment. So instead of having capital gains taxed on individuals that have held their assets for a year or more, they would be paying at their normal income rates under the proposal. This is a pretty big change. So a high earner or someone showing high adjusted gross income over $400,000 is kind of the number that the Biden team has used as a differentiator, would see their tax rate go from 20% on a capital gains basis to 39.6%, which is that new maximum ordinary income rate. So really a doubling of the tax rate. And what I think is also interesting and important to note is that middle income Americans would see a tax increase that's pretty significant as well. I define that as from 80,000 to 469, which is currently that 15% capital gains bracket. So that would be replaced with normal income tax rates from between 24 and 35%. So pretty big hit to what we would, I guess, probably call middle class. Number three, elimination elimination of step up in basis. This is a huge one for those involved in real estate, for those having real estate assets that they plan to leave to beneficiaries, because it is saying that instead of, I guess maybe I should have had this different or the other way around. Under current law, if I pass a property on to my child, they receive that property with a step up in basis. So if I have been utilizing Section 1031 exchanges and I've been deferring tax for decades while building wealth, while building a portfolio of properties, under current law, my child can receive that portfolio, or as much of that as I am leaving to them, with a step up in basis, meaning they receive it at the market value as of the day I died. And that deferred tax in the meantime is now forgiven, it's wiped clean. The proposed plan says, nope, there's no longer a step up in basis. So the inheritor is going to receive that property at the same value as the person giving it to them in their estate plan at the same price they acquired it at. So huge difference. And it basically means there's a dual tax liability. It would mean a payment of an estate tax upon that death, and then payment of income tax upon selling that property. So that one's a big one. And I guess real quick, I would say the good and the bad of these four items that I'm highlighting are, the more drastic they are, the less likely they are to pass. So talk about that a little more, but what I'm hearing, what my firm is hearing, what we're hearing as an industry of qualified intermediary firms is essentially that step up in basis. Wow, that would really be a major change in our tax system and in the way Americans have passed wealth down from one generation to the next. Therefore, there's bound to be an awful lot of fight to protect step up in basis. Here's a quote that I found at investopedia.com. Could prove very costly over time to heirs of appreciated property, and not just to the wealthiest. And that's something I always emphasize, as do my colleagues, when it comes to 1031 exchange. I was talking to my counterpart down in Texas today. She's actually presenting the same information to a group there tomorrow night. And she said that she had an interesting chat going on one of her Facebook pages. And someone spoke up and said, well, 1031 is just for the rich anyways. And that really gets our blood boiling, because we see day in and day out that that's not the case. A lot of the clients we work with, they have a property, they've inherited a piece of property from someone in their family. And, you know, they are normal, everyday working people. They're trying to build for their future. 1031 is a tool that can help them do that. And, you know, unfortunately, 1031 has gotten a little more of a stigma, because Trump has, you know, has been known to be a real estate mogul, and Biden and others, you know, opposed to Trump and his policies, have been pretty quick to say, we don't want 1031 because it's that Trump thing, it's for billionaires. So, you know, it takes a lot of education and grassroots efforts to get rid of that stigma and let people see the truth, which is, hey, this is something that's for every taxpayer. It's not for billionaires only. It's not even for millionaires only. It's for Americans. Okay, and finally, the fourth highlight, the real bummer in my world, the probable elimination of Section 1031 rather than restriction. We found one source that apparently had a quote from someone in the Biden team to the effect of, well, we would consider restricting 1031s to be available to those that have less than a $400,000 AGI, adjusted gross income. But that's it. The rest of the multitude of sources that talk about the Biden tax plan speak to the elimination of 1031, not just the restriction. So what does that mean? Well, that means that taxpayers could no longer defer all of those taxes I touched on with a 1031 exchange. So all of these things would return to being taxable at the time of sale. Now let's go back to the positive of 1031 for a minute, and then we'll touch a little more on, you know, what would happen with the repeal. This is a chart we put together, and the third row there reflects the Biden tax plan in terms of replacing capital gains rates with normal income rates, plus the 3.8% Medicare surcharge. So we've done iterations of exchanges, or in the case of not having an exchange, either because, you know, the taxpayer doesn't want to do one, or perhaps under the Biden plan, the taxpayer can't do one, what the numbers look like over time. So this is an example of identical properties being sold year two. So they've been held, they meet the requirements of 1031. There's a property value of 100,000. It's sold, it's reinvested, and right off the bat, because the exchanger doesn't have to carve out roughly 20%, kind of on the low end of the spectrum, but let's say, you know, conservatively, it's a 20% tax. They have $100,000 more buying power if they can put 20% down on replacement property. And then we'll go through iterations over time. This was at year 5. So now we've got a second sale or exchange, and the gap starts to widen pretty quickly. What's also interesting is you can see the difference between current tax law and the proposed Biden tax law in rows 2 and 3. And there's also fairly sizable differences there. And one thing I always find fascinating about this chart is that it has less to do with taxes paid at the time of the sale and more to do with, again, that wealth building power over time, right? So even though the exchanger only missed out on paying $42,000 under current tax law or a projected 55.5 if Biden tax law were in place, look at the difference they have in new property buying power, right? They're already 250,000 up on someone not exchanging under current tax law.
Hey, Ken, we got a question. I just saw it popped up. So I'm
Thanks.
late.
Yeah.
James is asking, what is the CES designation again?
Oh, sorry. I did see that little pop up. Thanks for bringing that up. Certified exchange specialist. So in my world, as a qualified intermediary, it's very much exchanger beware. There's no federal regulations for qualified intermediaries. There are about 11 states that have some form of legislation. Colorado is one of them. Came out with a House Bill 1054 to protect exchangers, but it's not ironclad. So you still certainly want to know who you're working with when you're working with qualified intermediary, or if you're advising someone, you might suggest to them that they just check out their credibility. My company has over 90 years of direct full-time qualified intermediary experience among a team of 6. I'm one of the more junior members at 8 years and counting. So we are very experienced. I think the CES designation is something good to look for. I'm on the CES Council, and our goal is to spread education about Section 1031 and also to instill the highest level of ethical standards possible among all qualified intermediaries. So that's what that CES is all about.
Somebody's asking if you can go back one slide. They want to get a screenshot of that, please. There we go. Is
that good? The 5-year?
Is that the one, Heather? You guys feel free to unmute yourself and jump in. Ken's willing.
Thank you.
Okay, you're welcome.
I got it.
Ken's willing to take the questions as we go, and if you want to put it in the chat, we'll put it in chat and I'll read it out. But feel free to just say, "Hey, Ken."
And Jim, I think you mentioned when we were getting started that we'll have the slide deck available on the RIG website as well.
Yeah, we're recording this. We'll place this on the RIG site, and we'll also have the PowerPoint, so you can get all the screenshots you like straight from there.
Right. Yep. You can always call me if you need something to, or if you have a related question on it. All right. So I couldn't resist using this term again, maximize your wealth velocity. So this is a 10-year picture. You can see the gap widening again. Now the exchanger has twice the purchasing power of the non-exchanger. And unfortunately, under the Biden plan, if you look back from the start, year 2 to year 5 to year 10, and then finally to year 20, one of the things that is concerning is that the wealth of that real estate under the Biden plan is on a very low curve, or a low trajectory. You've got current tax law 1031 exchange, the buying power over 20 years, it's quadruple what it is for a non-exchanger. Look at the Biden plan, unfortunately, meaning if the different things that the Biden administration is proposing become tax law, it's going to have major impact on the real estate industry and investors. And note too, this asterisk, that's going at the 27.8 end of the spectrum, not the 43.4%. end of the spectrum. So it's not a perfect representation. Of course, there are a lot of variables. We didn't fit into this simple graph. Um, I'm sure some could argue, the Biden plan looks worse on this graphic than it really would be. And I also believe there are others who would say, nope, that's pretty dead on, or it could even look worse. What about higher state taxes that may be coming down the pipeline as a result of COVID and the fact that, many states are strapped. They've had to, make massive outlays for their people, for, health and medical concerns, et cetera. Okay. In general, economic effects of the plan, according to one source, are as follows. And they're pretty significant also. You've got a retraction in GDP. You've got a lowering of the overall capital stock in the country. You've got a decline in the wage rates over 10 years, which, that is significant because in general, you see wage rates increasing slightly over time, not retracting. And then finally, loss of jobs. So that's from the Tax Foundation, which is known to be about as central as you can get on the political spectrum. I believe they are regarded as leaning slightly to the right, so to a more fiscally conservative view. But again, they're not radical in either direction. Additional economic effects. This relates to studies that were contracted for by my industry, the Federation of Exchange Accommodators, along with NAR and other groups. And it was done leading up to the Hillary Clinton presidential election, and the fact that her team had also targeted 1031 for elimination. There is a new study, actually that's on an upcoming slide, but so 4 or 5 years ago, roughly, there was a study done that said, well, without 1031, we're actually going to see a contraction in the economy, battling what some were saying in Hillary's camp that, well, again, 1031 is a loophole for the wealthy, and it's costing us, I think one of the figures was $90 billion over 10 years. This study said, well, wait a second, not so fast. If we look at this, not in a vacuum, but in the real world, if 1031 doesn't exist and there are far fewer transactions occurring because there's less incentive for people to invest or reinvest in real estate, we're actually going to see a cost to the national economy, not a benefit. So I guess I should have went to the next bullet. That's exactly what that says. Okay. As I mentioned, there is a new study just completed. We will certainly be broadcasting that information as soon as we have it. A couple of other interesting facts. 40% of realtors polled said that they would have seen some transactions either not go forth or not happen at all without the benefits afforded by Section 1031. And then finally, the idea that 1031, is a tax loophole and it allows people to skip out on taxes. Well, one other study said 88% of the properties people get in a 1031 are ultimately sold without an exchange, and then the tax is paid. I think, contrary to some people's belief, which is, oh man, there's going to be nothing left to tax because everything is exchanged. That's not how it works. The big picture, bit of a long quote here, but I thought it was pretty good. This was by a accountancy office saying, I think somewhat what we know, that typically when there's a new administration, there tends to be major change proposed. In the case of a Democratic administration coming in, we tend to see an increase in taxes proposed, right? And with a Republican administration coming in, we tend to see a reduction in taxes proposed. So I think what's really important in this quote is Georgia, because the control of the Senate hinges on those runoff elections that are coming up on January 5th. If one of the two senators on the Republican side wins, then we have balance between the three legislative parts of our government. We have a blue or Democratic presidency, a blue or Democratic House of Representatives, but the Senate would remain red. If both of the Georgia elections go to the Democratic person, then the Senate becomes Democratic controlled as well. You've got all three houses now blue. And of course, that means there's more likelihood of Biden's plans being pushed through. So that plays a big role in what will happen in the tax landscape and in the real estate investing landscape. And what does that mean? In some means be prepared, keep your eye out on what's happening, whether you want to contact legislatures now or wait and see what happens, certainly up to you. I've also heard from some respected folks that I see on occasion that are in the real estate and or tax world that a call to our legislators carries more weight than an email. So something to keep in mind, and certainly being active among whatever associations you might be involved with. I think Jim Rig certainly will serve as a place for information. And I hope to be a part of that too, and share as updates occur. So that's the big picture. We're in a little bit of a wait and see as we go through the transition into Biden assuming the presidency, and in particular with what's happening in Georgia. Are we going to still have some balance of parties among the branches, or are we going to see an all blue legislative sector, in which case there's more likelihood of 1031 repeal and these other things happening, and we need to really speak up for our industry and our livelihood and our investments. And that's it for me. Thank you. I appreciate your time and attention, and for attending. My information's there again. Welcome to call my cell phone anytime. If I happen to not pick up, I will be back to you as soon as I can. We're here to help. We grow our business by helping people get closer to their dreams through real estate. We love what we do. Thank you.
So anybody got any questions? He said it was going to be about a 40-minute, and he's almost dead on. So he's pretty good.
Did all right.
Either ask your questions here. There we go. Go ahead, Joe.
Hey, Ken.
Yeah.
Just quick question. So on the 1031, when you're exchanging for essentially like property or real property, can you exchange from a single family investment to vacant land with the intent that the use of that land would also be investment or leased out?
Yes, you can. Yeah, and you bring up a good point. I didn't touch on that too much. But yes, vacant land is considered to always be eligible for Section 1031 treatment. And really the only caveat is that you have the intent to hold it for some period of time. The IRS doesn't define that holding period within the code, but IRS case law says it's a year and a day, because in the IRS's view, the first year is a tax reporting year. That next day is another tax reporting year. So when you or I as a taxpayer hold a property for a year and a day, we've really held it for 2 tax reporting years. And that has shown to be 100% bulletproof in terms of IRS case law, as the minimum holding period. The other catch is someone can have a valid change of intent and not hold a property as long. For example, I had a client who did an exchange. He sold Colorado property. I think it was rentals. He bought one or more replacement property rentals, and then his job moved him to Michigan. And he called me up just a few months after he completed his exchange and said, man, I'm moving to Michigan. I'm kind of a hands-on guy along with my wife. I don't know if I've held the property long enough. And we determined that, well, you have, because you had a valid change of intent. You hadn't planned on selling it real quickly. You weren't, it's not like you bought it and you stuck a for sale sign in it right away. So back to your question, yes, land is also included as always eligible for 1031.
Does it matter as far as pricing goes? Meaning if, the single family home was $300,000, do you have to spend that much in the vacant land? Is it based on price? Is it based on size? How does that work?
Yep, also a great question. It is based on dollars. So when you do a 1031, the IRS says, okay, taxpayer, to the extent that you reinvest what you got out of that property, including debt relieved. So it doesn't matter if what you sold is free and clear or encumbered. It just matters what did you net from it after you paid closing costs and before you relieved whatever debt you might have had on it. So for example, if I sell something for 5.25, I pay 25,000 in commissions and fees. My net sale price is 500,000. That's one of the requirements of the code, section 1031, for full deferral, is that I invest equal or up. Now, I can reinvest less and still have a valid 1031 exchange and still receive tax deferral benefit, but I'm going to have tax exposure for the gap from my net sale price to my gross buy price. So if I only spend 400,000 on replacement property, in my example, I've got $100,000 of tax exposure because I didn't reinvest that last 100 grand.
Okay, that makes sense. Yep.
All right, good.
Thank you.
You bet.
Dan, you have a question?
No, I don't. Can you hear me?
Yeah, we hear you.
Sure can.
Yeah, I joined late. I forgot about the meeting, but yeah,
Glad you're here.
great. Thank you.
You bet.
Anybody else? We got plenty of film, so we can keep recording.
Right.
I had a question. Oh, of course, now, as soon as I said it, I totally forgot it. Can you give us some examples, first off, of things you can't 1031 exchange?
You bet. So prior to Trump tax reform, you could exchange personal property, meaning aircraft, semi-trailers, semi-tractors, locomotives, racehorses, collector cars, on and on and on. Well, there was some give and take, I think, in order to appease some in the legislature. And that part of section 1031 was done away with. So instead of the prior language, which was you can exchange property, the new language with TCJA was you can exchange real property. So that took away everything other than essentially real estate in all forms. Beyond that, you cannot exchange a partnership interest. So if you and I, James, have an LLC, we need to drop into tenant in common ownership if we want to go separate ways when we sell property that LLC owns, and I want to cash out and you're smarter than me and you say, well, I don't want to pay all that tax. I want to do a 1031 exchange into something else. We wouldn't be able to do that if we kept our ownership in the partnership, because the code says ownership interest is not like kind of real estate. So there's an example. A REIT would be another pretty common type of investment that is not eligible for 1031 exchange. And it's along the same lines as the partnership problem, where the IRS looks at a REIT and says, well, someone buying into a REIT is buying into a company as a owner of that company. And even though that company may own or manage real estate, we don't care. You can't sell real estate and buy ownership in a company such as a REIT. There is an alternative that I think came into being, I'm going to say roughly 15 years ago, called the Delaware Statutory Trust. Some of you may have heard of this type of structure. It is similar to a REIT. However, it's a more direct ownership, and the IRS says that works for 1031 exchange. So I can sell a condo and I can buy a 0.2456% interest in this giant complex down the road that's part of a DST. Even though I'm technically a very minor shareholder or partner in that large property, because it's a DST structure, the IRS says, well, that works because you actually own a small piece of that real estate. You don't own part of the company that owns the real estate. So I hope that's helpful, James, but that's some ideas. Primary residence doesn't work. And then when you get into a vacation or a second home, you're in some gray area. What my most expert colleague says, he's been doing exchanges since the year the original Star Wars came out. And he's been doing them full time since, well, for 26 years and counting now. Very bright guy, former real estate attorney before he got out of that business. But what he likes to say is he's never seen the IRS attack an exchange where the subject property produced income and that income was reported. That's a pretty powerful statement, because he's not saying, oh, well, you have to show a certain amount of income, or, well, you better not use the property much yourself or else you get in trouble. He's saying that doesn't seem to be what the IRS cares about. What the IRS cares about is, has that property shown any income? And if it has, we have yet to see the IRS go after it. So that says, if you have something that is a second home or a vacation home, if you rent it out some, if you're working on it some, and if you're using it some, you may be in good shape, or at least be taking on very low risk by participating in a 1031 exchange if you decide to sell that property.
Thank you. That was really good.
Okay.
For the personal property, personal residence, is that on either side of the exchange? For instance, if you were to sell personal residence and then put it into a 4-unit, exchange it into that, is
Correct.
can you do it neither side of the exchange? Personal residence, out of it, done.
Personal residence, to me, that could be a vacation home. I would say it as primary residence.
Yeah.
So 1031 is essentially off the books for a primary residence. You do have the section 121 capital gain exclusion that's there to help people reinvest in their primary residence with less of a tax burden, right? So under 121, any taxpayer can get $250,000 if they file single, or up to $500,000 if they file joint in capital gain exclusion, as long as they've owned and lived in their home for 2 of the last 5 years. That also brings up another concept of property conversion, which means if I decide to, my wife and I decide, my wife decides to sell our home, and sorry, let me say that again. My wife decides we need to move, and I can convince her that, well, maybe we don't want to sell it. Why don't we turn it into a rental for at least a year and a day? Now we can 1031 it. It's no longer considered our primary residence. It's now considered a business or investment property. It's 1031 eligible. And you can go the other way as well. So if we decide to buy an investment property on the beach somewhere, and turns out we really like that beach area, after a year and a day, we can move in there. That could be our new primary residence. It could be a second home. We no longer rent it. We no longer show income. But as long as we did for the first year and a day we owned it, we're in good standing with Code 1031.
Ah, I didn't realize it went that way too. That's awesome.
Yeah, so there's
Um,
some flexibility there. And sorry, James, the last thing I think
Mhm.
is maybe worth saying, because there's a lot of flipping activity going on, in the last 5 years, maybe especially here in Metro Denver, and I think, more than likely all over the country. Flipping would be another example of property that's not eligible. I mean, it's certainly business use, right? The problem is it doesn't typically meet the hold requirement. So the IRS says, well, if you buy something and your intent is to resell it, you're going to rehab it and resell it, we don't think that should qualify for 1031 treatment. That's inventory. That's property held for inventory, not property held for business or investment use. So our advice to someone who flips is you may want to do some math and decide on your risk benefit, or risk reward spectrum. Is an exchange worth doing by way of, I'm going to rehab, I'm going to rent it for a year, and then I'm going to sell it. If I have enough profit in my rehab, maybe I don't want to pay 25% tax on that. I'd rather rent it for a year. Maybe I barely break even. I got to pay a management company, and I know I'm going to have a little wear and tear. So I may not make a lot on the rental, but I pick up 25% on my exit because I didn't have to pay tax for my next project. So one more consideration.
I like that. And then I had one other question. I was curious, kind of playing devil's advocate with eliminating the 1031. You had mentioned that there was a study done. Did they do any kind of research on the revenues that would be, taxes that would be brought in, considering we have quite a much larger national debt than we had going into all of this? It seems to me that somewhat of eliminating 1031 is essentially higher taxes. Being able to pay back debt would be part of it, I would think.
Right.
What are your thoughts on that, and what's the any kind of data that you've read about that?
Sure. So if I understand correctly, you're asking, would there be a benefit to the elimination of Section 1031 in terms of greater revenue collected?
Yes, essentially, we've taken on this, huge national debt. We've pulled all these earnings from the future into the present. Has to be paid for some way.
Yep.
Higher taxes being that way.
Yep.
So is it, do we have to pay for that now? And is this the possible elimination of the 1031 a way to pay for that? What kind of taxes would that actually bring in? And
Sure.
I understand that it would have a very large chilling effect, right? People would not invest as much.
Right.
But even with that, people would still invest. It still makes sense to do it. It's just harder to accumulate and to grow as quickly.
Correct. I'm trying to find the slide that I mentioned the study on. There we go. Yeah, and here's the contradiction. So there was a study done by a federal agency, and I apologize, I don't have that on the tip of my brain. That study again was back in the Hillary Clinton campaign era, and it said if we did away with 1031, we would have 90 billion more dollars of tax revenue over a 10-year period. The study that the real estate industry essentially contracted for said, we don't believe that's the case. We think that by taking away 1031 and the related incentives to invest, we're actually going to have a reduction in the economy and a loss of tax revenue. So it's probably a matter of the truth lies somewhere in between. but it also brings up more questions. And, one of the questions that I've heard discussed, and again, given that, okay, I am in the real estate industry, could there be some bias? Yes, there could. But one of the interesting aspects brought up was, is that government study conducted in a vacuum? Meaning, did that result stem from the government saying, okay, we're going to remove the deferral and all of those transactions are going to become taxable events rather than non-taxable exchanges. And therefore we get, the 20% going into the federal coffers, and the states on average maybe collect 6%. Well, was that done in a vacuum? Meaning, did that study consider that there's going to be less activity because there's going to be less incentive for you or I or any taxpayer to want to reinvest in real estate? Even if real estate still looks like a decent investment without 1031 benefits, other investments catch up, right? Well, maybe I'll go into bonds. If I can only make a 3 cap after I pay taxes, geez, I can do about that good going into bonds. Whereas, in recent years, oh man, if I can do 8, 10, 12 cap in real estate, I don't want to go into bonds, right? So it is certainly evidenced, by that type of example, that there's going to be shrinkage in real estate activity. There probably, according to, I guess I would say at least people I've spoken with who are tax professionals, there's going to be erosion of real estate values as well, because activity would fall, right? And therefore demand falls, prices fall, et cetera. I guess the most hopeful response I can give as someone in my industry and position is, rather than looking at the tax revenue benefit if 1031 is eliminated, I think it at least warrants some serious consideration that there are studies that show it increases tax revenue. And that to me is logical, because you have more investors wanting to reinvest. They are wanting to buy equal or up. They're wanting to expand their portfolios because they have benefits around Section 1031. But along with that comes more revenue, right? If I own more properties, I have more renters, I have more income, I'm paying more income tax, right? I may get a deferral on my real estate, but I'm still paying tax on my income generated from the property. So I like to think, and I truly believe, Section 1031 is a good thing. And one of the other primary reasons I feel that way is I see day in and day out, I'm not dealing with millionaires. I'm not, it's rare that I have someone call me up and say, I'm selling a, $5 million, apartment complex. Most of the time, our exchanges are $200,000 to $500,000. That's the majority of our exchange value, which is great. That means there's a lot of taxpayers out there who they have another job, they have another source of income, but they're using 1031 to try and grow wealth and, keep up with the expenses of the world. So, okay, thanks. I'm off the soapbox.
Thanks. I like that. So it sounded like $90 billion over 10 years, which, considering trillions of dollars of debt, it's not really to drop in the bucket. Thank you.
I'm glad you brought that up, because I was thinking the same thing when I said that. It's crazy to think about, the $2 trillion tax relief that wasn't enough for the Democrats and it was too much for the Republicans, so we're stalled out, right? And here we're talking about, well, let's eliminate this thing that, is a fraction of just what we've had in COVID relief in the last 6 months. So it'll be interesting to see what the updated study shows. And I would imagine there will be updated information coming from the federal government too. I mean, it would make sense that, if Biden and crew and the House, maybe not the Senate if that stays red, but if those parties want to push through the elimination of 1031, they're going to need to back it up, and then we may see some other competing studies, and see what the new numbers look like. But I agree with you. I mean, 90 billion 5 years ago was maybe a little different than 90 billion today, but not on a magnitude of, anything close to what we're racking up here in debt and budget deficit. So yeah, thanks, James.
Alan has a question, and I'll read the question. He got his hand up. So if I mess the question up, Alan, jump in. It says, can I buy 2 properties, replace selling 1 property? And if I buy a more expensive property, how is the difference treated by the IRS?
Okay.
Selling 1, buying 2.
Selling 1, buying 2. Okay, great. Thanks for touching on another nice aspect of flexibility around 1031. There's no limitation for any taxpayer on the number of exchanges they can do, the value of the properties they can exchange. Geographically, I mentioned if it's on US soil, it can be exchanged for anything else on US soil. And quantity as well. So someone can sell multiple properties and buy 1, or vice versa. Someone can also sell 1 property and buy 4 different types of real estate in 4 replacement properties, meaning I can sell a condo and I can buy a piece of land and I can buy some water rights and I can buy an industrial property and I can buy a public easement, and they can all be in different states. And just as a side note, you can also work with my company, ideally, but any qualified intermediary effectively anywhere in the country to handle transactions anywhere in the country. So we routinely work with clients outside of Colorado almost as often as we do inside of Colorado. Of course, there are a lot of properties owned by out-of-staters here in Colorado. We're a very attractive place to be. Unfortunately, word's out on that, you may have noticed. But back to your question, you meet your maximum 1031 exchange benefit when you buy equal and when you reinvest all of your cash. Okay, if you don't do either or both of those things, you have some tax exposure. So if you buy up, then you're either taking on additional financing, right, versus your sale, or you're putting in additional cash. There's no additional benefit under Section 1031 for that buy up. There's only benefit up to the point of buying equal. And really the only, I guess, minor side note there is that when you sell, you get to net down your closing costs. And when you buy, you get to gross up any closing costs. Okay. Hope that answered it.
Alan, anything to add there? You can unmute yourself, or you can type in the chat.
Thank you. That was very good.
Great.
Anybody else?
Yeah, I have a question about if it were to be, and I think this falls into that it would be fine for the 1031, but if it's an Airbnb, and I think Boulder allows that for like 160 days, and then the rest of the year when it's not being Airbnb'd, it does have to be a primary residence. I think that's how it works. So would it work for that type of situation?
Well, I can hear Dan, my colleague, saying yes, because again, he has never seen the IRS attack an exchange or an exchanger successfully where there's income on the property. The challenge you get into may be the personal use, but I tend to side with Dan just on experience. So there are 4, I believe, safe harbors, if memory serves, that relate to section 1031, and safe harbor in the tax code says, if you follow these requirements, the IRS will not challenge you on that basis. So there is a personal use requirement, or sorry, personal use safe harbor, whose requirement is rent the property for at least 14 days a year for the first 2 years you own it, and don't use the property more than 14 days a year or 10% of the days it's rented out. So if you rent it out 200 days a year, you can use it 20 days instead of 14. However, that is a safe harbor, and someone can have a successful 1031 exchange without being inside that safe harbor. And we see that commonly, and we will talk to clients and their advisors. We will also tell them they may want to run it by their tax advisor. If they want to talk to us, happy to have a conversation. So a situation like that can come down to the taxpayer's risk tolerance. But again, I think our parting word on it would be, hey, run it by your tax advisor, okay? Here's what we know from IRS case law and the code, that if you have revenue on the property, if you're holding it primarily as a business or investment use property, it meets 1031 requirements. That said, our tax ID number isn't on your tax return. It's yours and or your tax preparers. You need to make that ultimate decision. But that is one of those situations where it can come down to, what's your risk tolerance. And we would say, for a couple reasons: one, there's revenue on the property. Two, we very rarely see audits on 1031 exchanges in general. You may want to consider seriously going ahead with that property in a 1031 exchange. We don't expect you to have a problem, even if the IRS were to select you for an audit.
Thank you.
You're welcome, Heather.
I've got a somewhat related question, Ken. More on, have you run into exchanges that involve more creative real estate acquiring, like, my brain is dead at this time of the day. Not lease options, but assuming mortgages, that kind of thing. And is there, if you assume somebody's mortgage or did some other creative form, have you run into those kinds of 1031 exchanges and rules associated with those?
Yeah, and I'm not very expert at some of that terminology. Does some of that, it makes me think of the term wrap.
Yeah, like a wrap, or assuming a mortgage is you just take somebody's mortgage over who just really doesn't have any equity, doesn't really have any use other than just to get rid of the property and not go into bankruptcy or not go into, whereas a wrap, you are, getting another loan and wrapping it around the existing mortgage. So yeah, I wondered if there were some sort of time requirements of owning the property for that period of time.
Okay. I'm not experienced in something like that. I think as well or better than I do that 1031 is triggered by an actual closing.
Okay.
So it does have to be a matter of, hey, I'm now in title to the replacement property, or I've now relinquished title to my old property. I have to meet that requirement to have eligibility for a 1031 exchange. So if I'm assuming a mortgage or making a loan, I don't qualify because the ownership hasn't changed of the underlying property.
Well, the ownership would still change. You're just taking on their loan. You're not getting a new loan to pay. So you'd still have a note. Yeah.
Okay.
Yeah, but I was just curious because I would think that, especially with the times that we're coming into, that there may be more of that.
And that's, thank you for that clarification. It's like a light bulb went on right here. That completely changes everything and gives me I think a pretty black and white answer, which is the IRS, to our knowledge, does not care about the nature of financing, method to acquire the property, equity, or equitable nature of the acquisition, et cetera. For good or bad, the code doesn't care. So
Okay.
yeah, if it was a qualifying property that the exchanger relinquished and they have intent to hold on the buy side, as opposed to, well, I'm going to bail someone out and sell this thing in 2 months, that would get them in trouble. But if they acquire it and they show as much intent to hold as they are comfortable with, then they can participate in a 1031.
Gotcha. Okay.
Yeah.
Thank you.
You bet. Thanks.
My sister Katie has a good excuse for not being so clear-headed. She's hours away from being a grandmother.
Hey,
Well, due date, that could be 10 days from now, right?
Or
Due
it
date
could
today.
it could be early. There's a lot of excitement going on out there right now. I want to get out and be a part of it.
In other words, I'm owed. But the good thing about being owed is that I'm old enough to watch the roller coasters go up and down through the years. And I'm much more Pollyanna and optimistic that if all hell breaks loose this next year, I just think that we tend to come back to balance. Eventually we come back. And of course, I'm more left leaning than most of the people probably on here. But I guess I'm a little Pollyanna that I think, hopefully we're going to make some reasonable decisions to say that didn't work. We got to balance it out. So I'm hoping for that for you, Ken, because I know that's got to make you feel a little nervous right now. I can't even imagine.
yeah, and,
Stuff.
to that point, Section 1031's been a target a lot of times.
Yep.
It's not just this year, it's not just 4 years ago, and it's hung in there. And fortunately for me and boy, a large number of people around the country who depend on 1031, to some extent for their livelihood. I mean, that's a lot of people involved in investing and these DST companies and realtors, and it's a long list. I think we can take some comfort in the fact that, one, it survived the test of time, and two, real estate investing is non-political, right? Whether you're as far left or as far right as you can get, you can find people at those ends who also invest in real estate. So we like to think that, hey, if we look at the facts around Section 1031, and hopefully we can conclude once we, get the anger out of the picture, like, I don't like that because Trump used it and therefore it's terrible. If we can get rid of those types of arguments, hopefully some facts come to light that say, this thing is good for the economy and it has been for 100 years and it's available to everyone. And a lot of people use it across the income spectrum, right? It's not just this thing for the richest 1%. We like to think, hey, it's used by about 90% of the income spectrum in the country. So,
yeah, it's unfortunate what happens with the posturing that goes on with both parties.
Right.
Because what it comes down to is you don't know what it really means in the end. And I agree with you. If we can have enough leveled headedness to say, this is middle America that's doing a lot of this.
Right. Yeah.
So good luck.
Yeah, thank you.
To all of us.
Good luck to us all.
So Ken, I have a question.
Yes, sir.
Yeah, so when did the 1031 exchange start? What year, do you know?
Yeah, 1921.
Wow.
Yep, little before my time. It was enacted to help farmers and ranchers at the time it was enacted so that they could expand livestock and lands basically without, being punished in the form of taxes. So that's how it came about originally.
When do you think it moved into real estate, into houses and residential real estate?
Well, I think it became mainstream in the 80s. That was kind of the first real major revisions and clarifications to the code. The Starker exchange, which said, okay, we're no longer going to require an exchange to involve only two parties, meaning, Dan, you and I have to exchange with each other. We can't, I can't buy over here and sell to you, and you're buying over somewhere else. We can only exchange with each other. That was a big breakthrough. And then also the concept that we can have a delayed exchange, not simultaneous. So early in the code life, you had to do it simultaneous, and you had to do it back and forth with one other party. And so in the 80s, that started to change. The reverse exchange was basically clarified around 2000 to say, okay, we're going to make some rules about how you can do an exchange when you want to buy something first and sell later. And that has come to be a pretty important part of what we do too. It's probably only about 10% of our transaction activity is a reverse exchange structure, because it's a more complicated and expensive type of exchange. But because it provides that flexibility, I bet it's 20% or better of the dollars that we see in exchanges. And it's something that looks pretty attractive in a market like we have right now in Colorado, maybe that we've had for a few years, right? It's very much a seller's market. It's a tight market. You better get your offer in or the property's gone in 2 days. Well, with the reverse exchange, if someone has the means, right, either they can obtain financing or they've got somewhere else they can pull resources from to go and buy first, they can accomplish getting that perfect property that they want without having to sell the old property first and hope that it's still there. So, yeah, there's been quite a few iterations in the code. But yeah, I'd say the big breakthrough came in the 80s, and then somewhat unfortunately, the repeal of personal property exchanges a couple years ago. But that really was targeted as, well, wait a second, this isn't about the wealthy using it. It's about the Fortune 1000 using it. We're not sure that Hertz Rent-A-Car should be able to do 1031 exchanges and never pay taxes on their tens of thousands of cars that they're going through and making money on every day. That had a lot to do with the personal property side being targeted.
And the other thing is, when did that concept of like kind come to be? When you're exchanging for like kind?
Well, that's a good question. So livestock, for example, and personal property was always in narrow channels. So if I sold a jet aircraft, I could only buy another jet aircraft. I couldn't buy a Ferrari or a house. Livestock, I just thought this was fascinating. I could only exchange same-sex livestock for some reason. So, if I had steers, I couldn't get sows or cows. I had to get steers. I believe, though, real estate goes back to day one, but it was just restricted to, hey, it's got to be, we're changing deeds, we're sitting down at a table and we're swapping deeds simultaneous, and there's no third party involved. And then for some years it was, well, okay, you got to have the qualified intermediary. They actually have to take title in the middle of the exchange. So that was a hassle, right? Where I would be saying, okay, I got to go to this closing because I got to sign because I'm taking title, and then I'm going to turn around and here's the buyer of the seller's property, and I got to assign title over to them. Fortunately, that was done away with in the 80s as well.
Okay.
Yep. Oh, the things I can tell you about code.
Steers for steers, though, huh?
Yeah, great bedtime stories, put you right to sleep. Now I'm glad you're all showing a lot of interest, and I appreciate it. It can be boring. I try to touch on the more interesting parts of it, and I think I think you see the value in it, which helps to make it more interesting. You know, when it's relevant to what you might be able to do as an investor, it certainly comes to life more than just, you know, tax code.
Anybody else? Don't be bashful. We're all friends. Well, I'm gonna talk about a few things here, and then if a question comes to mind, jump in. But this was, as I said earlier in the introduction, Ken did a wonderful presentation at a RIG meeting. It was a lot of questions, a lot of discussion, and it was like time, we're out of time. It was like, we'll do this specialized, dedicated webinar where we don't have to go through all the formal meeting with all the stuff that we do at the meetings, but this is what this was about. And we've got a couple other that's coming up soon. We did David Van Stinkus did a thing on raw land investing, no toilets, no tenants, no contractors, just dirt. And there was a lot of questions about that. And we had some issues too, so I really owe him coming back. We're going to do a webinar with David coming up soon. And recently we had a very good discussion about private lending, not hard money, not bank, but you being the bank, you loaning money, or you how to go borrow money from Katie, or it was private lending. That was a very good discussion, and we really ran out. We ran long that night, so we're going to have a Tim Emery and Katie and Dan, hopefully, and David, and come back, and we'll have a focus group on private lending. I've done some lending. It was shortly after I met Katie, that's how I started in the funding business. Was I took my strip plan and it helped finance some of her deals, and I was like, wow, this is pretty cool. So that's coming up soon. Something we're trying as a trial is what we call the weekend wind down. This is very casual, very informal. We're just going to gather, get your favorite beverage, a snack, a dessert, and we'll all gather in and just say, well, so what happened last week? So what's coming up this week? And we're going to talk a little bit, just what's going on. Very informal, no set schedule, no slides. And you'll be able to get, maybe regain some contact with friends you hadn't seen in a while. Maybe you'll meet some new friends. Maybe you'll meet some new business partners. And you get a little bit of group accountability. And I'm gonna let Katie talk a little bit about accountability. She started Inc. Investors Network Community way back. I came in, became a partner with her. She let me kind of I was her sidekick for so many years. And then
Would you stop? You were
I was Katie's sidekick.
partners.
But we worked together quite well. We didn't always see eye to eye, but we love each other like a brother and sister, and we put up with each other, and we're still here. And she's taken Inc. and kind of went in a new direction, more focused on accountability and groups. And I take their existing membership list and started RIG. Kevin, he's on here. He's one of my board members that keeps me in check now. He kind of kicks me in the butt when I need it. But we're going this way with RIG and more, I guess, global and not so much focused and dead on. But Katie, you want to speak about what you're doing with Inc. while we're here?
Oh, thanks, Jim. Yeah, sure. Basically, I have always been drawn towards masterminds, smaller groups. And as I shared with Jim, it's really something that aligns with the networking groups like RIG and ICOR and IROC and all the rest. Is it's for a small group of people, 5 to 7 people max, where people come together in a mastermind. If you're not familiar with that, it's just, where people come up with their goals and they come up with a very specific action plan and they meet regularly. Kevin and I were in a mastermind that we just have this friendship that I think we all formed that is just, for me, it's lifelong. We just still check in with each other. But anyway, it's just the idea of an accountability group that holds your feet to the fire, and you meet on a regular basis and you have your plan and you come together each month and say, here's my challenges. You get 20 minutes in the hot seat, and that's a good place. And then you get to have this small group, this mastermind, kind of brainstorm your challenges and come up with ideas for you and support you. So that's what we're doing. And I've decided, Jim, I told you, I gave you the link for next week's meeting to sign up for it, but I'm going to go ahead and do, I think maybe the day after or maybe Thursday the 10th, I'm going to do sort of a sample, like a taster mastermind meeting, where I just offer, like a free mastermind meeting, a 2-hour meeting. And then the first several people who sign up can be in the hot seat. And so it walks people through an actual mastermind meeting, so you know what that looks like. So I'm going to do that as well. Thank you for letting me talk.
Of course. I love you. You're my
Love you
sister.
too.
I have to throw that part in.
I know. We are forever siblings.
Although when we were working together, there's a lot of times like, it's like we're married, but we worked well together, and I support everything she's doing with Inc. She supports Riggs, so we're continuing to be friends, and we will always be. And there's Nan popping on here. Nan was there at the start of all of it. Speaking of the next meeting, we're going to come together. It's going to be a 100% Zoom meeting next Tuesday night for our December meeting. And one of the parts of the meetings we have every month is called OMGs. Oh my gosh, or oh my God. It can go either way. And we keep telling everybody you need to share those OMGs. Well, next week, it's going to be a little bit of a OMG. I'm going to tell you a little story of some lessons I've learned since I tried to start this money-making endeavor thing. And my business kind of went through several different versions, and I learned along the way, and it's going to be a little bit about that. I think the headline's paying fewer taxes. That's the goal. Tonight was about paying fewer taxes, but it's not going to be a tax thing. It's going to be talking about structuring your businesses, working with CPAs and accountants. Don't just say, here's my books and walk away. There's a lot of communication needs to go on. I found that out in the last few years. So I'm going to kind of share and go, oh my God. But that's coming up next week for our December meeting. In January, it got pushed back, but in January, we're going to be talking about working with contractors. Vincent Koo's going to be here, and our favorite contractor, Inc. business member, Ray's Remodels. He's going to be there as a contractor. We may expand that, but we're going to talk about dealing with the contractors, what we need from them. And Ray's going to talk about what he needs from us. But there's been a lot of interest in that, and it's got pushed back, but hopefully January, we're going to do that. And then in February, it's probably the biggest meeting of the year, the most well-attended and the most requested is Manfred Shemek, who's been there from the beginning. He's part of our board for RIG. He's going to do his annual economic forecast. He spends almost all year long tracking so much stuff, and he comes together and because this is what I think is going to happen. And every year I always say it, but I like when he goes, remember back 2 years when I said this? Well, it happened here. So Manfred knows his stuff. So he's going to be in February. And then probably in March, whoever's going to be going, we'll know what the tax is going to be like. We may have another CPA come in March and talk. March is up in the air, but that's kind of what the stuff's coming up. Nan, you got to speak up. You were there at the beginning and you're still with us.
I'm sorry I missed the whole thing. I had other commitments this evening, but I will look forward to this recording.
Ken did a very
Hi, everyone.
Hey, I just wanted to echo what Katie said about the masterminds being developing lifelong friendships. And Katie, so some of my big master goals that I put together, I look back, they're about 2 years old or coming to fruition. Now they're happening. So isn't that awesome? A lot of the different aspects of real estate investing I've had going on are happening. So anyway, that's what I had to throw in.
Thank you for throwing that in. Me too. It was that, yeah. I loved our group. Me too. I finally am listening to all your advice.
And Joe, I'm not going to attempt your last name there, but Joe was one of the first ones on tonight. He said this was his first rig event. So I hope he found it valuable and interesting enough to at least click in on the next one.
You guys are amazing. Yeah. Again, thank you for having me. Loved it. Good information. Thank you, everybody.
Thank you. Sean, any comments from you? You were quiet all night. Or Joe Lund?
That's because I had kids in the background. So, no, I think, Ken was spot on everything that he was saying and forecasting if Uncle Joe gets put in office. And I'm sure you could take all the studies from 15 when they were forecasting that Hillary was going to get in there and pretty much duplicate that. So it would be a shame to see it go away, but yeah, we'll see what happens, I suppose.
Like Katie said, the real estate, it's that roller coaster, up, down, and I've been to a lot of big summits, and I've heard the experts stand up and say no matter where it is on the ride, you can make money as long as you know what to do, you can make money on any point of that curve. So that's what
right. Yeah, that's what I like about real estate. I'm sure people say you could do that with the stock market too. I just don't understand the stock market like I understand real estate. So
well, thank you for joining, Sean.
Yeah, thanks for putting this on. It was great.
All right. Well, I guess we'll bring it to a close. I hate to close it, but cheers, everyone. Hope to see you online in the next one. The weekend wind down Sunday afternoon, and then more important, our meeting next Tuesday night. Rig, we love you guys. Thank you for coming. Have fun making money.